In 1973, investors believed their favorite stocks could never fail. Then the S&P 500 lost nearly half its value, and untouchable leaders collapsed without warning. What if today's market, driven by a handful of giants, faced a shock just as severe? The true risk isn't always what you see in the headlines. The answer lies where confidence meets regime change. The S&P 500 reached its high of 120 in January 1973. At first, the drop seemed manageable, a correction, not a collapse. But as months passed, the decline did not stop. By November, the index had already fallen below 96, erasing years of gains. Each brief rally sparked hope, only to be followed by another leg down. Headlines swung between reassurance and alarm, but the numbers kept slipping. Oil embargo news broke in October, and inflation began to surge. By October 1974, the S&P bottomed at 62.28. That is a 48% loss. Nearly half the market's value gone in less than 2 years. For investors watching their portfolios, the ground felt like it was shifting beneath their feet. The usual rules stopped working. The leaders everyone trusted offered no shelter. Each failed rebound chipped away at confidence, not just capital. The drop was not a single event. It was a drawn-out test of patience, nerve, and belief in the system. Even seasoned professionals described the experience as a slow-motion earthquake. Every aftershock a reminder that safety was an illusion. The question that haunted everyone: if the best stocks could fall this far, what was really holding the market up? Valuation is often invisible until it snaps. In the early 1970s, many of the so-called NiftyFifty stocks traded at price-to-earnings ratios that would raise eyebrows even today. Some technology names carried price-to-earnings ratios over 100. Investors believed these companies had such strong futures that no price was too high. But when the environment changed, the market stopped paying those stretched multiples. It did not matter that the businesses were still growing or that earnings had not collapsed overnight. What changed was the willingness to pay tomorrow's prices today. Think of a stock's valuation like a rubber band. In good times, optimism stretches it further and further from reality as future growth is priced years ahead. But when inflation spiked and interest rates climbed, that rubber band snapped back hard. The market started valuing cash flows much more conservatively. Suddenly, the same company, with the same earnings, could be worth half as much. Multiple compression is a silent force that can flatten even the best-loved leaders. Stock returns are not just about earnings and dividends. They are also about how much the market is willing to pay for each dollar of profit. When you buy at a high multiple, you are borrowing from your own future returns. During the 1973 to 1974 bear market, the payback came all at once. The companies did not have to stumble. The math did the damage. For investors, it became clear. Prices can fall hard and fast, even when the story has not changed. Only the market's mood has. Losing half your money is not just a gut punch. It rewrites the math for years to come. If a portfolio drops from $100 to $50, it does not take another 50% gain to get back. It takes 100%. Every dollar lost needs to be earned back, and that climb is much steeper than most people realize. In the aftermath of the 1973 to 1974 bear market, the S&P 500 did not return to its old high until July 1980. That is nearly 6 years spent just digging out of the hole. During that stretch, inflation kept eating away at real returns, and investors watched as time, arguably their most precious resource, slipped away. This is the hidden cost of severe drawdowns. Not just the money, but the opportunity. While the market spent years recovering lost ground, new ideas, new businesses, and new cycles were already starting to take shape elsewhere. For those who needed to cash out or who lost confidence and sold near the bottom, the damage became permanent. The lesson is simple but often overlooked. When markets fall hard, the road back is long. And every year spent recovering is a year you cannot use for something else. Drawdowns do not just hurt, they steal options, and they steal time. The collapse of the NiftyFifty wasn't just about numbers on a screen. It was a chain reaction set off by the very structure of the market. By late 1972, these so-called one-decision stocks were everywhere. IBM, Xerox, Polaroid, Avon, and the rest. Pension funds, mutual funds, and individual investors held them as core positions, convinced that quality alone could weather any storm. The average price-to-earnings ratio for the group hovered around 42, double the market's historical norm. Names like IBM and Xerox had become anchors in portfolios, symbols of progress and reliability. But when the market's mood soured, those same qualities became liabilities. The first blow came from valuations. High multiples left these stocks with much further to fall. IBM, a bellwether of American innovation, saw its shares cut nearly in half. Xerox, which had dominated its field, dropped over 70%. The damage wasn't limited to just those two. Across the board, the NiftyFifty's declines dwarfed the broader market's pain. For funds that had loaded up on these leaders, each leg down forced a hard choice: hold on and hope, or start selling to meet redemptions and margin calls. Here's where the second hit landed. In a crisis, liquidity becomes king. The most widely held, most liquid stocks, ironically the supposed safe havens, were the easiest to sell when redemption requests spiked or leverage needed to be unwound. Institutions did not dump the obscure laggards. They sold IBM, Xerox, and the other giants. Forced selling turned price declines into a feedback loop. Each sale drove prices lower, which triggered more selling. Retail investors who thought they could ride out the storm watched as their one-decision stocks became sources of cash for someone else's exit. The headlines lagged the damage. In boardrooms and brokerage offices, the story shifted from optimism to survival. The myth of immunity vanished. What looked like strength on the way up became a trap on the way down. Concentration in leaders did not just magnify gains, it magnified risk, especially when everyone tried to leave at once. NVIDIA stands at the center of today's market narrative. Its story is more than chips or artificial intelligence. It has become a shorthand for future growth, innovation, and the belief that technology can outpace every challenge. But history shows that even the brightest narratives can run into the hard wall of valuation. The lesson from the 1970s is not that great companies disappear. It is that the price investors are willing to pay can change almost overnight when the environment shifts. The math that powered NVIDIA's rise, strong earnings, expanding markets, and a willingness to pay ever higher multiples can also work in reverse. So how do you stress test a leader like this? Start with 3 questions. First, are inflation, interest rates, or policy changes likely to move the discount rate in a way that would force investors to rethink what they are willing to pay for future profits? Second, are today's leaders priced as if nothing can interrupt their growth? Are the assumptions baked into their valuations too optimistic, leaving no room for error? Third, is market leadership broad, or is it concentrated in just a handful of names? When leadership is narrow, the entire system gets fragile. If 1 or 2 giants stumble, the impact ripples through everything else. This is not about calling tops or bottoms. It is about understanding the mechanics that drive both euphoria and panic. Every era has its own version of the NiftyFifty, the dot-com darlings, or the housing boom favorites. The pattern repeats, a powerful theme, a handful of leaders, and a market that grows comfortable with risk until it does not. If you want a practical next step, copy these 3 questions into your notes. Use them as a checklist whenever you see a dominant theme driving the market. For those who want to dig deeper, I will pin a comment with links to historical S&P data, inflation charts, and a list of past market leaders. And here's a question for you. Do you think the biggest risk today is macro, like rates and policy, or micro, like competition and earnings? Drop macro or micro in the comments and add your 1-sentence reason. Next time, we will look at what happens when leadership turns from tailwind to tripwire. Market confidence is fragile. Even icons can lose their shine in a new regime. With over 30% of the weight of the S&P 500 concentrated in just 7 stocks, history warns, valuation risk hides in plain sight. Complacency is never safe. What changes the game isn't always what you expect.